The collapse of Lehman Brothers, one of the largest investment banks in the United States, remains one of the most catastrophic events in modern financial history. On September 15, 2008, Lehman Brothers filed for bankruptcy, triggering a global financial crisis that would cost the world trillions of dollars and reshape the global economy. To understand how this disaster unfolded, we must trace the events that led to Lehman's fall, the key decisions made by the bank and its leaders, and the far-reaching consequences of that fateful day. Lehman Brothers was founded in 1850 by Henry Lehman, a German immigrant who established a dry goods store in Montgomery, Alabama. Over the years, Lehman grew into one of the most respected investment banks on Wall Street. By the early 2000s, the firm was a major player in the global financial markets, particularly in the areas of investment banking, securities trading, and asset management. Its business model was centered on the practice of leveraging large amounts of debt to generate profits, a strategy that would eventually lead to its downfall. The origins of Lehman's collapse can be traced to the housing bubble of the mid-2000s. Fueled by low interest rates and a boom in the housing market, Lehman Brothers and other financial institutions began to heavily invest in mortgage-backed securities, MBS, a type of financial product that was created by bundling home loans into tradable assets. These securities were initially seen as highly profitable, as housing prices were rising rapidly, and the demand for mortgage-backed securities was at an all-time high. However, as the housing market began to show signs of overheating, the risks associated with mortgage-backed securities grew increasingly apparent. Lehman Brothers, along with other banks, continued to invest heavily in MBS, even as the market started to turn. The firm's exposure to subprime mortgages, loans made to borrowers with poor credit histories, was especially high. In fact, Lehman had invested tens of billions of dollars in these high-risk securities, which had become increasingly difficult to sell as the housing market began to unravel. By 2007, the first signs of trouble began to emerge. The subprime mortgage market, which had fueled much of the housing boom, began to collapse. Home prices started to fall, and borrowers began to default on their loans at an alarming rate. As a result, the value of mortgage-backed securities began to plummet, and the financial institutions that had invested heavily in them began to suffer significant losses. Lehman Brothers, which had been one of the largest investors in MBS, was no exception. The firm faced billions of dollars in potential losses, and its balance sheet was increasingly strained. Despite these early warning signs, Lehman Brothers continued to operate as if it could weather the storm. The firm's leadership, under CEO Richard Fuld, remained confident in their ability to navigate the crisis, even as the value of their assets continued to fall. Lehman tried to shore up its finances by raising capital through various means, including a series of debt offerings and the sale of assets. But these efforts were ultimately unsuccessful, and Lehman's exposure to toxic mortgage-backed securities continued to grow as the financial crisis deepened in 2008. Lehman Brothers' troubles became more apparent. In the spring of that year, the firm reported a massive quarterly loss of $2.8 billion. Its stock price began to fall sharply, and investors began to lose confidence in the firm's ability to survive. By the summer of 2008, Lehman was actively seeking a buyer, hoping to avoid a full-blown collapse. The firm approached several potential buyers, including Bank of America and Barclays, but was unable to secure a deal. The final blow to Lehman Brothers came in September 2008, when the U.S. government, led by Treasury Secretary Henry Paulson, decided not to intervene to save the bank. In the midst of the financial turmoil, the government had already provided a bailout to other institutions, such as Bear Stearns, but decided that Lehman was too large and too risky to save. The decision not to bail out Lehman Brothers sent shockwaves through the global financial system, as investors realized that no financial institution, no matter how large or influential, was too big to fail. Lehman Brothers filed for bankruptcy on September 15, 2008. With over $600 billion in assets and $613 billion in debt. It was the largest bankruptcy in U.S. history at the time. The news of Lehman's collapse triggered a chain reaction in global markets. Stock markets around the world plummeted, as investors feared that other banks and financial institutions were similarly exposed to the same risks. The collapse of Lehman Brothers also led to a freeze in credit markets, as banks became unwilling to lend to one another. This lack of liquidity exacerbated the economic crisis, and within days, global financial institutions were scrambling to shore up their finances. The collapse of Lehman Brothers did not just lead to a financial crisis, it also exposed deep weaknesses in the global financial system. The firm's failure revealed the dangers of excessive risk-taking, poorly regulated financial products, and the over-leveraging of debt. It also highlighted the interconnectedness of the global financial system, as the collapse of one institution could cause a ripple effect across markets and economies, die in the aftermath of Lehman's bankruptcy. The US government and central banks around the world took dramatic steps to stabilize the financial system. The Federal Reserve slashed interest rates, while the US Treasury and other governments around the world initiated massive stimulus packages to prevent further economic collapse. In addition, the US government established the Troubled Asset Relief Program, TARP, which allocated $700 billion to stabilize the banking sector. Despite these efforts, the global economy was plunged into the worst recession since the Great Depression. Unemployment soared, businesses failed, and millions of people lost their homes and savings. The collapse of Lehman Brothers had far-reaching effects on the global economy, and the repercussions of the financial crisis are still felt today in the years following Lehman's collapse. There were significant changes in financial regulation. Governments around the world implemented new rules and regulations designed to prevent another financial crisis. In the US, the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in 2010, aimed at increasing transparency and reducing the risks associated with financial institutions. The Basel III framework was also introduced, which increased capital requirements for banks and sought to improve global financial stability. Despite these regulatory changes, many critics argue that the root causes of the financial crisis, excessive risk-taking, inadequate regulation, and a focus on short-term profits, have not been fully addressed. Some argue that the global financial system remains vulnerable to another crisis, as banks and financial institutions continue to operate in ways that are not fully transparent and continue to take on high levels of risk. The collapse of Lehman Brothers stands as a stark reminder of the dangers of financial instability and the far-reaching consequences of poor decision-making. It was a moment in history that changed the financial landscape forever, and the lessons learned from that event continue to shape the way we think about finance, regulation, and risk today. In conclusion, the bankruptcy of Lehman Brothers was not just a failure of one institution, it was a failure of the entire financial system. It exposed the vulnerabilities in the way global finance was structured and highlighted the dangers of unregulated risk-taking. While efforts have been made to prevent another crisis, the legacy of Lehman's collapse serves as a cautionary tale for future generations of investors, regulators, and policymakers. It serves as a reminder that in finance, as in life, the consequences of unchecked risk-taking can be devastating. The collapse also marked a significant shift in how governments and financial institutions would approach risk and regulation in the years that followed. Lehman Brothers' bankruptcy became a defining moment for both financial markets and global economic policy, and its lessons are still relevant in today's highly interconnected and complex financial system. The ripple effects of Lehman's fall continue to be felt, with economic policies and reforms still being shaped by the lessons learned from that devastating event. The story of Lehman Brothers is not just a story of a bank's failure, but of the systemic risk that lies within global financial markets, waiting for the right trigger to set off a chain reaction.